Hello and welcome to the market update for Tuesday, August the 16th. As always, if you have any questions during the week or any that I don't get to here in the live class, make sure you send those to Jerry at traderspro.com. We're getting quite a bit of mixed signals the last few trading days. Last Thursday, I was talking about a pretty strong bearish reversal that was taking place. The market shook it off on Friday and is kind of inched higher the last couple trading days, including today, where it opened lower. Well, the Dow opened positive, but the Nasdaq and the other indexes opened lower and have rallied off that open, have come up off of that open. So, this kind of gets into what I was talking about a couple weeks ago, where I said that I thought that we would kind of have this melt up type of environment or a panic buying that takes place as people start chasing the move, and I still think that it's possible that could happen. I think we're seeing that happen a little bit over the last few trading days, but there are also some warning signs that are starting to show up that we might be close to getting a correction or a pullback of some sort. Now we're due for one. We've kind of gone up a little bit too far too fast. The question then becomes, okay, is it just a normal correction within a bullish trend, or is it a trend reversal, or is this a bear rally and we're gonna go retest the lows from back in June, or even go lower than that? Right now that's a little bit too early to tell. I can say that the rally over the last week has turned some of those that were previously more bearish, turned them a little bit more bullish. You're starting to see a lot more bullish talk on CNBC and some of the financial websites and things like that. A lot of people starting to say they believe that the bear market is over. We're going to go up straight up from here. Those are kind of the conditions you get that you kind of need in order to start some sort of panic sell-off. When people think it's behind us now and they feel confident buying, and then the market kind of pulls the rug out from underneath them. So, but again, I don't see any. Well, I thought the reversal on Thursday was pretty significant, and it didn't follow through. We'll look at that here in just a second. I'll talk about a few things, but even before we get to the charts, starting off with our direction alerts, they're signaling, and I talked about this last week, that we're starting to move into that overbought condition. You can see that momentum is not yet in the extreme range, but it's very close. And remember, these indicators update after the market closes. So I would assume if the rally of today holds, that we should see this move into the extreme range. But again, it's not in the far right side of it, so it's not in an area where I would say a reversal is imminent or very close, or pullback is very close. We could still rally from here for a few days or so, and from at least a momentum standpoint. Breadth, you're in the middle part of that extreme range. Again, with the update after the market closes, assuming that the market holds the rally from today, I would assume that would move a little bit further to the right side. But there again, there's still some room in the far right side. Now, I'm not saying you have to get to the far right side every time to signal an overbought market, or a market that could pull back. There's been plenty of pullbacks that have happened anywhere in this extreme range, or even in the high range. But when you're talking about a signal that means it's very, very close, yeah, when these things get to the far right side, you're talking within a day or two or three or so. Within a couple of days, you're probably going to see some sort of a pullback or drop when you get those extreme levels. And you don't get that very often, but that's what I'm saying. You want to pay attention when it does happen, because it can be a very strong signal that something's about to happen. So from a trading standpoint, you tighten up your stops, you exit some of your profitable positions, take profits. You would do those defensive things that anything that you would want to do prior to getting a pullback. If you didn't want to be in a holding your stocks through a pullback, you would do all those trade management things when you're starting to get this type of signal. And you say, well, couldn't you still? What if a market rallies 2 weeks or so after it hits that extreme range? Well, I've been using this indicator for a long time, and that'd be pretty rare. Usually, like I said, it's within a few days. But even then, you'd have to ask yourself, what's the risk of trying to grab that extra dollar profit versus the risk of having it drop $10 or something, and it would drop a lot faster than it would be going up. So you're seeing it right now. Yes, we're kind of going higher, but we're kind of inching higher. We're just barely kind of grinding higher. When it drops, it's going to drop very, very quickly. So that's where the greed comes in. Is if you're letting greed take over and you don't want to leave anything on the table, and you're trying to grab that extra 50 cents, you're going to really be crying when it turns into a $10 loss when things start to drop. So you want to pay attention to these signals and because they're warning you. And people all the time tell me, boy, I wish I could know ahead of time that some of these declines are going to happen. I've been doing this a long time, and almost every major decline we've had in the market, I've called about 3 or 4 of them about a week before they've happened. Again, not that I'm smart or anything. It's just because I know what to look for. I know what the warning signals are, and this is what I teach in class too. In fact, if you go into the archives, go back to those old recordings if they're still there. Go look you go look a week before the COVID collapse. I was talking about something big was about to happen, and the markets were signaling that a big sell-off was likely to happen. You get these little warning signs, and then it's just a matter of what you do with them. And again, I'm not saying you panic when you get them, or you. I'm not saying to go short because there's not anything in the price action just yet that would tell me that a reversal is imminent. But you'd be prepared to if you wanted to short stocks or buy those inverse ETFs. You could start to look for an entry in some of those. But so the breadth is pretty extreme, and we already know sentiment's very extreme. And so there's an extreme amount of complacency in the market. Really, right now, there's really no fear of a market sell-off. And again, that's problematic from the standpoint of if it does start to happen, everyone's going to be doing the same thing. All those professional traders are going to be running to buy those protected puts at the same time, and it's going to cause the VIX to really spike up. And we did see a little bit of a divergence this week. I want to say it was Monday or Monday. Well, we only had 2 days this week, so it was. I don't think it was. Was it yesterday? It might have been yesterday, where the market was up and the VIX was up. And again, that's always a warning sign. It's telling you that some of those professional traders are starting to buy some protected puts. They're nibbling a little bit. We didn't see it spike up real big, but it's one of those little subtle clues that you want to pay attention to. And we're going to do the same. So from the direction alerts, again, they're showing overbought. Obviously, there still could be some room to become even more overbought, but we want to recognize that. You go to the buy-sell ratios, we're pretty wide right here. Now, the last couple updates, I said, this is pretty wide, but we've seen it get even wider. Well, now we're getting close to these extreme ranges. So we are pretty extreme. Could it go a little bit further than that? Yeah, it can always do that. These are not going to be exact signals. Okay, they're going to just tell you what the conditions are, and we are definitely in an overbought condition. So what does that mean? It means it's riskier to be entering into a lot of new positions in this environment. You want to be getting in right when things start to pull back. You'd want to be, but on the other hand, you don't want to be panicking out of trades that are working. That's another thing I need to point out is it's not that we're going to start getting out of everything. But like I said, tighten up your stops or start looking for. What I usually do is I'll recognize the condition I'm in, and then I start looking for the price action, because the price action, remember, is very short term. The candles that you're reading on the charts are very short term. So I'd look for a bearish reversal candle. That could tell me the very next day that the market could drop. And if I already know I'm in an overbought condition, I get that bearish reversal candle, then I could start exiting positions or taking profits off the table and things like that. Or even start shorting if you want to short stocks at that point, or buy those inverse ETFs. So this is showing extreme sentiment. This sentiment indicator is still below the red line here, but it's very close. And like I said, with today's move, we're probably going to get very close to it after it updates overnight. And it wouldn't take much of a continued move higher to push that thing into that extreme range. We're definitely close. So we're the same thing. It's the same thing that we're seeing on the other indicators. Overbought, but still could have a little bit of room to go a little bit higher. And then again, I don't go through this very often, but I told you to kind of keep an eye on it. But if you go to your index tab, this is showing the buy-sell ratios of all the different indexes. And what I told you is when you start to get double-digit ratios, you're overbought. You're getting it extreme. And look at the NASDAQ 100. Not only you double digits would be like 10 or 12 or, something like 10, 11, 12, something like that. This is at 36. Look at there's 72 buys and only 2 sells. That's pretty extreme. Okay. Now, again, this is not a immediate indicator. We've had double digits on a lot of these for the last couple of weeks. Could it become more extreme? Yes. But again, we're just trying to recognize the conditions we're in right now. And S&P 500, you want more of a broad index right here. 357 buys, only 6 sells in the whole S&P 500 index. It's almost a 60-to-1 ratio. You say, well, let's go more broad. The Russell 2000 is not quite in double digits, but the Russell 3000 is. So that's kind of odd. But that is one thing that some of those small companies they have lagged a little bit. But you also realize that a lot of those small companies have I mean, they're like penny stocks now. Some of them are $5 stocks or $4 stocks, and there's not that much further they can drop. But again, this is showing extreme overbought. Now let's take a look at the charts. And the area I was talking about for the last, for a while now, has been those June highs right here. And again, we paused along there the week before, or last week, or even in that, and then we broke out above it last week. This was the bearish reversal day on Thursday. Now, again, why was that a significant reversal? Well, because we gapped up at the open. We opened all the way up here, but then we closed lower than where we opened, although still it was pretty much right where we closed the day before. And it really doesn't matter as much whether you close below where it closed the day before or even a little bit higher. I like it sometimes when it closes higher than the day before, because everyone that's looking at the indexes will say, "Oh, the market was up today. That's good," but they're not recognizing the internal momentum that's going on, that's showing a reversal. Okay, and that's hopefully, if there's anything I've taught you in the classes, you gotta learn how to read that price action. Okay, anytime you see a red candle where you're at the top of the move, it opened higher, it gapped up at the open, it's closing lower than where it opened. I'm telling you, about 90% of the time, you're going to pull back from. Now, it's not necessarily going to signal a downtrend. Okay, it could just be a pullback within the trend. But I'm telling you, about 95% of the time, you're going to get a pullback off of it. Here's one that happened. Now, again, the key here is that you want to have a run up, ahead of that reversal. We had one recently. Here we had a little run up right here. And then you had a bearish reversal candle, and it just pulled back a little bit right here. It didn't pull back very much, and then took off again. Here you had a little bit of a bearish reversal candle, although it was in the context of a sideways move, which isn't as strong. You usually like to see it at the top of a move. Here you can say it didn't really work, but you really didn't move up very far from that either. You had one day where you moved up, and then you get a bearish reversal candle. It shook it off. Here's one right here that took place. The next day it tried to open stronger, and that really caused it to drop down. I'm telling you, these work, especially the ones that close where they close higher than the day before, lower than where they opened, but higher than the day before. Those ones I know are about a 95% probability that you're gonna get some sort of pullback the next day. And that's what I'd be looking for now. We know we're in overbought condition. Do we get another one of these? Because sometimes when it shakes it off like this, it's very rare. But one thing I've noticed is when it does shake it off over the next couple of days, a lot of times you end up getting the move. It just happens a few days later. So this is kind of the early warning that things were not good. And then you start looking for another bearish reversal. Now, we've had kind of the opposite though happen the last couple of days, where we tried to open lower. So people are buying the dips right now. You're opening lower. Here's where we closed the day before. Opened lower yesterday, managed to rally higher or close higher. Same thing today. We opened a little bit lower. We're trading higher. Now, I think if you want to make a bullish case here, and this would be, again, this is what could create that grind higher that I talked about a couple of weeks ago. Now, that's very difficult for me to trade. I thought the conditions were there that we could get it, and knowing how professional traders think and these big fund managers, how they think, they got to show a return for the year. If they're going to keep their job or even have a prayer of a bonus, if the market starts grinding higher, they may not want to be chasing the move, but they're going to feel like they have to, and that could cause the conditions to get even more overbought. That's why I'm definitely not saying you want to short just because you have overbought conditions. But one thing, the second area I was looking at after it cleared this high right here was there's congestion in this area right into here. And it goes back even further than this, but really we just need to kind of look at it from right here for now. And we bumped into it yesterday. We opened at it today and then dropped or we opened lower today, but we rallied up to it. Then we actually came back down to the lows of the day after. It looked like it was bumping into this resistance, but now it looks like it's clearing it. If we close like this, that would be very bullish near term for the market, because it's been a pretty significant area. Like I said, it tried to break out above it here. It couldn't. Like I said, we go back a little bit further. Let me see if I can go back a little bit further and show you right into here. It was support right into there, resistance right into here, resistance here. It rallied up to it, came back down, then broke above it. And now it looks like it could be clearing it. All right, so now, for last few updates, the last couple updates we started to look at it, but what we need to start looking at now are some of the other indexes as well, because those can be important for us to pay attention to. Particularly, I don't usually spend too much time on the Dow because usually it's just not broad enough. S&P 500, Nasdaq 100, Russell 2000. Those are really the real key indexes for me. And the Nasdaq, you can see, is kind of lagging today, and it could catch up again. But it dipped a lot lower at the open. After the open, it's managed to come back. It is at the highs of the day, but we're barely trading above yesterday's high. That's something to pay attention to. Do we fade into the close today, or do we close at the highs? If we close at the highs, that's going to be pretty bullish. We should expect to see some market strength tomorrow, or at least to open higher tomorrow. By the way, tomorrow is the Fed minutes release. It's the only Fed news we're going to get this month. All the Fed meetings are already done and over with. It could, again, if we're looking for a trigger for a sell-off or a pullback, that might be something that could do that. It could do the opposite. It could really cause a melt up as well. But that's something to be aware of, that there's something the market's really going to be focused on tomorrow. And if you're looking for some sort of a trigger to cause a reversal or a pullback, that could be one of them. But we're barely trading above the highs here. That's something to pay attention to. Because remember, we tend to look at Russell 2000 and the Nasdaq 100 as kind of leadership groups. Technology tends to be leadership. Russell 2000 is lagging a little bit too, although it looks a little bit stronger. You can clearly see it's trading above yesterday's high, but it did the same thing as Nasdaq, opened down, traded lower here, and just over the last hour or so has managed to break out a little bit higher. Now, I will tell you, another thing that concerns me a little bit is the breakout higher, the Nasdaq 100 and the Russell 2000 breaking out higher. This happened. Like I said, just about an hour and a half ago, where it started to do this. Why is that significant? Well, this is lunchtime. Okay, this is why I do my classes at this time. The middle part of the day, the professionals aren't really that active. And it's usually amateurs that trade a lot during the middle part of the day because they don't know any better. And there's professionals that trade against those amateurs to try to take advantage of them. But anytime I see a move in the middle of the day, I don't trust it. Now, again, it doesn't mean it's not significant. If we rally, if an hour from now, as we get close to the last hour of the trading day, you're starting to see that surge into the close, then usually professionals close the market. That'd be a good sign. If it fades into the close, that's something to pay attention to. Remember that phrase. The phrase is that the amateurs open the market and professionals close the market. Again, it's a general phrase. It doesn't mean that every amateur is the only one trading when the market opens. That's not true. And there are plenty of amateurs that trade at the last hour of the trading day. But what happens a lot of times is that the professionals usually, all the news comes out in the morning, right? All this stuff, we get bombarded with every bit of news coming out before the market opens. And typically what happens is those amateurs, they're going to react to that news right away. They're very emotional traders. And so they will, as soon as that bell goes off, they're jumping into whatever trade they want to get into because they don't want to miss it. And they think that they've heard all this news. They think they're an insider, that nobody else has heard this news. Like their CNBC is only for them. It's only broadcasting to them. And so they react, especially if it's moving up and they're afraid they're missing the move and they're missing out. They jump and they chase it. Professionals usually sit back and, like I talked about many times, that first half hour to an hour, they're sitting back, kind of seeing where that direction is, seeing if it's a valid direction or not. Because usually, if it's the amateurs, it's not going to hold. They're just not big enough to hold a move. So you'll see the market rally in that first half hour, and then it fades. It comes right back down because they weren't big enough to sustain it. If it holds it and is moving higher throughout the day, then usually that's professionals that are jumping in, and they're doing their steady buying that's causing it to move up incrementally during the day. And then if it closes like near the highs of the day, it means those buyers, those professionals, were buying all the way into the close. If it starts fading at the end of the day, then it tells you that they're not there. Those professional traders aren't buying. It doesn't necessarily mean that they're shorting, but it means that they're not buying into the close, which could mean that they're not trusting the future movement. Now, again, these are general statements. I don't want you to, base your trading decisions off of that. But it's just, that's why you want to pay attention to these particular times of the day, how things look after the first half hour to hour of in the morning, and then particularly how things look in that last half hour as we close. So we'll see how these end up looking towards the end of the day. I don't see anything right now that would indicate that I expect them to fade at all, just because it has been pretty steady, the rise since the early morning weakness, and that's usually a pretty bullish sign. When you get the volatility, when it's swinging back and forth a lot, that would be that's usually typically more bearish. Okay, when you start getting swing, wild moves back and forth, that tends to be a little bit more bearish. Bonds aren't giving us any direction. As I keep going back to, we saw it break out, CLT breakout right here, barely reversed right below it again. Then we saw the move last Thursday where it really dropped. It looked like I said that we could get an impulsive move down, or maybe it takes us to new lows. But immediately it just has been going sideways. So we're still in a sideways move. It's not, signaling any direction just yet. If it gets back above this high right here, that'd be bullish. If it obviously drops below this low, that would be bearish. On the way up, this was a higher low right here. This was a higher low right here. It'll be interesting to see this. So far, it's still kind of a higher low. If it does find a low right here and starts moving higher, let me erase some of these lines. I think if it drops below this line right here, it's at least more likely it's going to come down and test these lows. It is moving sideways right here after a decline. So you're wondering if it's just basing for a move higher. That could be what's happening here. But we don't have any clear signal yet of what's going on, because it could be that this is a correction within the downtrend and you're going to get another move down. That's a possibility as well. But I think what's more interesting is looking at the high yield corporate bonds chart. I've added this to our chart. Added it down at the bottom. Let me go backwards here. Probably the quickest way to get to it. Now, this is something I haven't really paid much attention to. I usually don't pay much attention to it at all, but it's become more significant, and it's mostly because usually the market's not focused that much on it. It's not a big market mover until it is, and right now, with the focus on interest rates and bond movements and bond yields and all that stuff, there's there's an interest in it. But the market has been moving with the chart. It looks like almost the same chart, but it's been kind of following this chart, meaning this chart has signaled some of the rallies ahead of time. And it could be signaling a possible pullback right here. As you can see, last Thursday we had a bearish engulfing pattern on the high yield corporate bond chart, HYG. The next day, the market rallied higher off of it. We had an inside day on the HYG. Yesterday, the market moved higher. We have not, today the market is moving higher. We're not seeing any confirmation from this chart. Okay, now again, I'm not suggesting that we're going that this is now going to be a huge part of your analysis every time you every time you do your market analysis for the day. But this is what the market is focusing on right now, and so I'm going to focus on it. When everyone else is watching this and making decisions based off of this, I want to pay attention to that. This goes back to, I think I've talked about this before. There are times, I remember a few years ago, every day the market was focused on, well, actually this is several years ago. This is back when some of the countries, the European countries were going bankrupt. Everyone was focused on the European markets, the whole market, U.S. markets. Every time the market opened, it was how is Europe trading? And we were looking at all the major markets, Great Britain, France. We were all focused on that and how they were moving, and then we were making our trading decisions based on how those charts were looking and how Europe was trading. Now, I haven't looked at. I don't even have a clue. And this is no offense to if you live in those countries. Okay, it's just I'm not trading those markets, so I only focus right now on the U.S. markets. I have no idea what those charts look like. I have paid no attention to how Europe is trading for a few years now because the market isn't focused on it, and I don't need it necessarily for my decision making, and so I don't particularly look at it. That'll happen from time to time. The market will focus on something, it'll become obsessed with it, and then it'll move on to something else to get obsessed with. And so there are things. So the point I'm trying to make is your routine. There are parts of your routine that are pretty steady that you're going to be looking at every time, and these are the things I go through in these updates. And then there are going to be things that we'll look at on occasion particularly if the market is focused on it, and you're doing it because the market is focused on it. It's right now the market is really obsessed with the Fed too. That's why tomorrow could be significant. There's obsession with the market's kind of always obsessed with the Fed, but even more so than it normally is. It's really trying to look at any the way that Chairman Powell used the word "it" or something like that. How it sounded a little bit different than how he normally says it. So that's got to mean something. I mean, really, the market goes crazy like that sometimes, where it gets obsessed with some of these things. But right now, there are these little nuances that the market is focusing on, and you got to kind of focus on them too. So I promise you, probably 6 months from now, you probably won't hear this chart ever again. But this is something to pay attention to right now, and it's not, so far the last few days, it's not confirming this move higher. Now again, you combine that with what we've gone over so far in the update, overbought market, a couple of weak opens the last couple of days, but we have moved higher, managed to grind higher. Well, you say, well, Jerry, what if this thing suddenly takes off? What if we break out above that high? Well, that would be bullish. Don't get me wrong, but remember, this is supposed to be a leading indicator. That's why the market's focused on it right now. That's not leading. If it's following the market, it's not leading. So the point I'm trying to make is the fact that it's not leading. Is this an early warning sign? It could be that this follows the market, but maybe this was the early warning sign that the market is in trouble. We already talked about a few other early possible warning signs. Thursday being one of them, where we had that bearish reversal candle. And we'll tuck this away. You know, again, I don't see anything in the daily price action to indicate that pullback is imminent. But who knows? By the time we get to Thursday in the next update, we could get it tomorrow possibly. Market gaps up because of all this positive momentum. 10 minutes comes out, maybe it sells off into the close, and it gives you that bearish reversal candle. Who knows? But anyway, I wanted to kind of put a little bit of focus on that. And I may bring this up a few times in the next few updates until I feel like there's no need to focus on it anymore. All right, so gold, not worth spending that much time on. It's been just kind of back and forth, sideways, down a little bit right now. By the way, there will be a time when if the market starts to really focus on gold, it'll be, and it has been in the past. There have been times when gold has been the focus of what everyone's talking about. But right now, it's really been erratic, and that's why I'm encouraging people to stay away from it right now, because it's not really showing a clear direction. And part of that is, I think I talked about this before, that especially JP Morgan has been accused of manipulating some of those precious metal markets, and so I don't have a very high level of trust in them right now. So until that changes, until I can see a more consistent chart patterns, price action, then I'd probably stay away from it. Oil's down. It's been more. That's been a more bullish aspect of the market. It's been a driving part of what's driving the rally in the market. I would point out that you do have a little bit of a descending triangle formation here on oil, which would indicate that you're probably going to break to the downside. However, if for some reason you start seeing oil rally and rally strong, that's going to be bearish for the market. The market's looking for inflation coming down, oil coming down as a big, part of that. They're not spending as much filling up their gas tank, and so they've got that extra money to spend somewhere else. At least theoretically, if that starts to go back up again, then that's going to put that's again more inflation pressure on the market. At least that's how the market's going to view it. The dollar, it had this little dip down right here, but this is still looking like a bullish ABC pattern. With the movement we've had the last 3 trading days, it's looking like an impulsive move. Today looks like a little bit of a pause. Now, who knows? It may start moving like the bond market, which just starts moving sideways, and we start looking at this as a big, long sideways move in a week or two. But now, a strengthening dollar could be viewed as being a little bit more bearish for the market. However, remember, the dollar and commodities tend to move inversely. So as long as if the dollar is rallying and oil is coming down, then I think it's okay. But if you see the dollar going up and oil going up as well, that's really going to be negative for the market. Now, I don't want to draw the conclusion that a rising dollar is always bad and a dropping dollar is always good. That's not what I'm trying to say here. I'm saying right now in these conditions, the dollar strengthening is viewed as being a little bit more bearish for the market. But I don't see the fundamental conditions for that to change anytime soon. But again, I'm not a fundamental trader anyway. I'm a technical trader. So if we start seeing the dollar drop sharply and have that impulsive move, then I'll change my mind on that pretty quickly. But this is so far looking like it should continue to rally higher. And if it changes, I'll point that out. Now the VIX, the VIX is really low right now. Now, again, you don't just assume that the market could sell off just because the VIX is low. But typically when the VIX has come down to these levels, we've seen the market sell off. The last time back here in June, or back here in April, May, we saw the VIX spike up through here again from these levels. Now this chart is not the perfect representation of the VIX. It's ETF that trades the VIX futures, and so I pointed this out. There isn't a chart of the VIX I can pull up on Traders Pro, so we use this as kind of a proxy. And this isn't showing what I was seeing, what happened yesterday. Let me confirm that real quick, that it was yesterday. I gotta look at something here real quick. Yeah, it was yesterday, which is weird. It's only, I guess that's a reflection of me getting old. I couldn't even remember that it was that soon. It was yesterday. But it's not showing it on the VXY, the VIXY here. So yesterday, what happened is we had the Friday move lower on the VIX, and then yesterday the VIX opened higher. And actually, it ended up closing higher than where it opened. Now, it closed lower than when it did the day before, or it closed lower than the open, but it was higher than the day before. So it was showing it was up. Now, again, typically, or you should be seeing the VIX and the market move in opposite directions. So when they move in the same direction, the market was up. Now, it's not, make sure you're comparing apples to apples. You're comparing the SPY or the S&P 500 with the VIX. Don't compare the Dow with the VIX or the NASDAQ with the VIX. Again, those of you that are new, the VIX is measuring the implied volatility of the S&P 500 index options. So it's not the Dow index options or the NASDAQ index options. It's the S&P. So you want to make sure that you're making that comparison. S&P was up a decent amount yesterday. The VIX was up a pretty decent amount, although it was off the highs, off to where it opened. It was still up. What that tells me, and it's real subtle, it's not something I'm going to make a trade on, okay, that alone, but it's telling me that people were hedging a little bit yesterday, not quite trusting the rally. I think we're seeing a little bit of it today, though, with the market higher and the VIX is not going much lower here, okay? It's kind of resisting that drop, meaning there's probably some people that aren't quite trusting the rally. Maybe it's people just hedging ahead of the Fed minutes tomorrow. That could be. That's why, again, we're not going to make this. We're not going to make this big prediction off of something so small as a small divergence like that. But again, you want to pay attention to it. It's a clue, and it could be warning us of something. Now, what would be the thing to react to? Well, if I see a bearish reversal candle tomorrow, I'd say, okay, that's why we were seeing some of these bearish signals. There's a good chance with that bearish reversal candle that we see a pullback, and then that's when I would be, getting out of some of my trades, tightening up stops, looking at inverse ETFs, things like that. All right, SMH. It's lagging a little bit. Here's the June highs right here. All the major indexes have broken above that. The SMH, and by the way, this is another thing that was was causing me to be a lot more bearish. You had the drop in the chip stocks, big drop in the chip stocks. That was last week when NVIDIA warned. They had their warning that came out, and Micron, I think, came out with a similar warning. Tried to rally, and then we had this bearish shooting star candlestick formation. That was Thursday when the market had that reversal. And again, we're right at this resistance area. Man, I thought for sure we were going to drop on Friday. But again, that's always a reminder that you can never know exactly what the market's going to do. Like I said, that candle formation, like I said, 95% of the time, it's going to work to some extent. It was the 5% this time, and the market will do that. It will do the lower probability move because that's what creates a market. You can't have certainty in a market, otherwise you don't have a market. You can't have price fluctuations if everyone knows exactly what the price should be. But now, again, could you view this opposite where you had that bad news that came out, it shook it off. It could be breaking out above to a recent high here. It could break above that June high. Yeah, all that could happen. But again, it'd be lagging and it's supposed to be leading. Okay. And that's what concerns me is that the market could still move higher, but maybe this is one of those early warning signs not to trust the rally. I don't know if I understand the question. The question reads, why there is no ETF best dividend like stock? Can you just take a little bit more time and word that a little bit different so I can understand your question? I'd like to answer it, but I don't understand. It could just be a typo there somewhere. All right. So again, that's something to pay attention to. We're not getting confirmation of this breakout from the chip stocks sector. Now, on the flip side, the transports are confirming it. Transports broke out first before the Dow did. Remember, we're comparing the Dow transports with the Dow industrials. It broke out ahead of it, of the Dow breaking out, and it's confirming it's leading. So if you want a pretty strong bullish signal, that's a strong bullish signal right there. If you see a bearish reversal though on the transports and the market and the Dow's going higher, that would be because remember it's leading. The transports are a leading indicator. That would be a pretty strong bearish sign. But no, this is confirming the Dow move at least. And then Bitcoin, like I said, this is very similar to bonds where we're wondering if it's forming kind of a basing pattern. It's going to start moving higher. It's just been moving sideways though. But here again, the fact that it's sluggish. Now Bitcoin is, whether you like it or not, is going to be viewed as a risk indicator. Traders that feel like they can take on more risk or can be or feel more confident the market is going higher will get into riskier assets. And I know that Bitcoin is not trading on the stock exchange, so why is you tying that into it? Well, first of all, there's a lot of crypto traders, and so I've included it in the update just to give them my opinion on what the chart looks like of Bitcoin. I'm not going to get into all the cryptocurrencies, but as we saw with the COVID crash, and then the results afterwards, when the government was giving these checks out, people were buying Bitcoin. They were buying cryptocurrencies, Dogecoin, and some of the wacky ones out there. They were piling into those. So it's become a reflection of risk on type trades. And so right now we're not seeing risk on as far as Bitcoin's concerned. We're seeing the Russell 2000, which is also kind of a risk-on indicator, a little sluggish. Again, these are clues that we're just going to kind of tuck away and see if they become more relevant later on. And then I added that HYG. We already talked about that. All right, so bottom line, conditions overbought. They could keep grinding higher. And again, I made that argument. If you want to go back a couple weeks, I talked a lot more in detail of kind of why I felt like we could get kind of a panic buying, or people chasing a move. Very difficult for me to participate in that, even though I know it can happen, just because I know when it reverses, it can reverse so sharply that's usually what leads to those big, huge drops is there's that panic buying right before it. And so usually I don't like to chase it. I like to sit back and wait for the signal to short or to buy those inverse ETFs. And I don't usually short stocks. I usually buy put options when I'm betting on things to drop. And we'll probably do that in the portfolio. I've got positions right now I'm just kind of sitting on. I don't want to add too much in these conditions, although I'll go over a few stocks today that we can look at. But I might get a little bit more aggressive. If I see a bearish reversal candle, I'm going to probably get more aggressive with the inverse ETFs. So let's take a look at the portfolio real quick. Kind of a little bit stagnant the last week, just because some of these have just kind of been moving sideways a little bit. I still have Raytheon, a little bit of a bearish candle today. Usually when you have that's called a bearish inside day, when you have a run up like this, and then you have a large bullish candle, and the next day you have a bearish candle, so it's in the opposite direction and it's inside the candle of the day before, what we call a bearish inside day. Typically, you're going to get a pullback out of that, or it's going to drop a little bit off of that. Now, again, we've got an hour before the market closes. Could that change? Could it rally all the way up to the highs of the day? It's no longer an inside day if it does that, or could it drop? Well, if it dropped below the low there, it's still a very strong bearish candle at that point, and probably would likely lead to a pullback the next day. Let's see. Here's an example. Big run up, bearish inside day, drop. I can find another one here. They don't happen all that often, but you need to recognize that price action because it's very bullish. Now it's very bearish. The opposite would be bullish. That's what happened here. Not much of a drop there, but we had a down. Here's a big down candle. Then you had a bullish inside day right there, and it went up the next day. But again, context is important. And usually I would have wanted to see a bigger drop ahead of that. Would have made that reversal stronger. If you only have a real quick one, it doesn't mean it still can't work. It just means it's less reliable. Or if it's been moving sideways and you get it, it's less reliable. Anyway, my stop though is down here, so it's not like I'm going to want to just jump out of this thing. In fact, maybe what I could do is move my stop up. I think I have it down here. Let's move it up to here if I haven't already done so, just to tighten it a little bit because of the conditions we're in. If we were to break below that low, let me point it out right here. That would be bearish. I probably would want to be out of it if it did that. So that low of that day is $90.96. Let's do $90.90 just to make a round number. Let me see what I have it at right now. Yeah, I have it at 81. So let's move it to $90. What did I say? $90.90, right? Yeah. All right, so I'm going to change this to $90.90. Now, what that'll do is if we get stopped out, we got in at 91, so it would really reduce the loss. We still have a loss, but it would greatly reduce the loss. We barely have a loss on that. So now, what could be another decision I could make? In fact, let's. Well, another decision I could make, and maybe we'll just do that. Is we're in an overbought market, and I'm getting a bearish inside day on this. Why even let it have a chance to come down to? Now, normally I would just let the trailing stop get me out. Let me be clear on that. But I've done a lot of things different than when we've been in this bear market. There's bear market strategies that are different from bull market strategies. There's, when you're in a whipsawing market that's not really trending in a meaningful way, that there's other strategies you might implement. Again, we can always get back in this again if it comes back and starts breaking out. Even tomorrow, if it shakes that off, it breaks out above here or something, we could always jump back in it again. I think if this is moving back up, it's likely to move all the way back up to this 106. So plenty of opportunities to get back in. If this is an overbought market and it's about ready to pull back, there's a very good chance I'm going to end up getting stopped out if it starts selling off. So could I make the decision right now? Again, I'm not making it just off of being afraid I'm going to get back the money I'm going to make, but this is telling me we should pull back, we should drop. Like I said, we have a gain right now. Do we want to turn that into a loss? I'm going to decide no, I'm not. So let's go ahead and just get out. Again, we got in at 91, we're getting out at 95, roughly, a little less than a $4 move there. It's close to 92, so about a $3 and change profit. Let's go ahead and take that. We're at 95.08. And I'm going to sell all 85 shares. And we got almost a $300 profit there. Big one, but it's something. Go ahead and sell it. Now, the SPY, see, we're off the highs. Wow, look at that. That's significant. If we close like that, that's pretty significant. So we'll see. We'll see how things close. But you see why I didn't trust the move it was making in the middle of the day. What I would have rather seen, what I'd like to see typically is I'd like to see for a bullish candle, I'd like to see it start rallying about a half hour after it opens. I don't care what it does when it opens. It could be back and forth or whatever. But see it steadily start rallying after about a half hour of the market open. And then the middle part of the day, either just stay there or even pull back a little bit. And then in that last couple hours, start steadily moving higher and then close at the highs of the day. That's a really bullish price pattern for a stock throughout the day. Now, again, there's a lot of variations to that, and I'm not suggesting that even then that it would have to be bullish the next day too, but this is the opposite of that, where you start seeing it fade. You see it rally in the middle part of the day, and now it's fading towards the end of the day. That's why I spent time in the beginning of class talking about how professionals close the market. Amateurs are usually trading at lunchtime when the professionals are getting a bite to eat. All right, that's something to pay attention to. Now, I'm not going to jump out of this one though, for the most part, because I hedged. Remember Thursday, I hedged it with the SARK. I wanted to keep this one because I thought we could grind a little bit higher. I still do, because maybe we still grind higher. If I get a bearish reversal candle tomorrow, I'll be out of this, and I'll maybe add to the. Well, I won't add to the SARK. I'll probably get into the SOXS. We'll look at that one here in just a second. Go to CNQ. This is a natural gas trade. And natural gas is actually, um, it's actually been more bullish than oil, although that's a bearish candle today. But I'm not going to get out of this one just yet. I think I have my stop down below this. I had it pretty tight, I believe. I think I'm down below this low right here. Is it right around $50? I think is that where I have my stop? Yeah, my stop's at 50. So yeah, we'll hang on to that one. ON, a little bit of a bearish inside day, and we're kind of stretched here. We had this big run up right here. I'm going to go ahead and just jump out of that one. Like I said, maybe that's a bearish candle, but maybe all it does is come back and test the breakout right here and then take off again. I can always jump back in. Let's clean up some of these, or let's jump out some of these bullish trades. Just maybe we'll be adding to it on Thursday. Maybe we'll jump right back in, but let's go ahead. I'm going to go ahead and take profits on this one. Currently at 50, oh no, that's 70, the $70.38. Sometimes the price when you pull up the form is different than where it's currently trading at. So make sure you adjust that. So this one made 500, almost 600 bucks. So we'll take profit on that. Let's go ahead and sell that. And the last one I own is the SARK. Got into this one on Thursday with that bearish reversal that we had, because I wanted to stay into my long positions, and we haven't dipped below that. We had a couple down days here, but we haven't dipped below that candle. We're down a little bit on the trade because I got in near the end of the day there. But this is another fairly bullish looking day, off the highs a little bit there. But more than anything, I'll hold this as a hedge to that SPY trade. If the market takes off, SPY takes off, this will probably go down, but we'll make it up. And actually, the SPY has gone up more than this has gone down in the last few trading days. So the difference, we still made a little bit of money on the difference there. But I'm using this one as a little bit of a hedge. Again, for those that are new, this is a inverse ETF for the ARK Innovation Fund, ARKK. And this is Kathy Wood's fund. She invested a lot of these smaller companies. Well, not all were smaller. Her big holding is Tesla. But these are companies she thinks are innovators that are going to have potential to be big over the next few years. They did really well after the COVID drop and the COVID rally, with the rally we had after that. And she was the darling of Wall Street when that happened, but she's kind of held on to these all the way down as they come back down and dug in. And so somebody came up with a fund that goes opposite of it. So the fund will go up when this goes down. And so what this allows us to do is, if we think the market's going to go down, this will probably go down with it, because a lot of these are small cap stocks, and a lot of them don't have earnings, so they're more likely to be in trouble if the market drops, so they'll probably go down. But this allows me, by using the SARK, which is that inverse ETF, it allows me to still be long the stock, to still buy the stock. I don't have to short it, because there's risk with shorting stocks. Shorting stocks is not just the opposite of buying stocks. There's a lot of differences, or big differences. But this should go up if the market goes down, and it allows me that we made a lot of money on those market sell-offs using some of these inverse funds. And the other one I like is the SOXS. This is the opposite of the inverse of the semiconductor index. Chip stocks tend to be a leading indicator. So if the market is going to start selling off, chip stocks will probably be leading the sell-off. So that's why I like this one. Not to mention the fact that you can get big moves on these too. You say, if we get a decent sell-off, this can go from $35 to $45 on just a halfway decent sell-off. Okay, $10 move. You say, well, why don't you use the SH, which is short for the S&P 500? This one goes up, but the S&P 500 goes down. Well, I could get that same move, and I'm only making 50 cents or $1, but not even $1. I just can't make enough to make it even worse. I'm not hedging anything. I'm not making anything on it, so I can't really even hedge with it. So I prefer some of those other ones that, and you got to have liquidity with them. There's a lot of inverse ETFs out there that have no liquidity, but there's a lot of people right now, at least, that are trading the SOXS and the SARK. So I've been kind of sticking to those two right now. Anyway, that's kind of the explanation on that. So on the SOXS, I am going to tell you what I'm going to do, because this is looking like it could be a bullish candle. It's off the highs though a little bit. It could be just part of, let me check the SPY to see if it's still kind of fading a little bit. Maybe it's come back. Ooh, it's really faded. Ooh. Let's do this then. Let's go ahead and get into the SOXS. And here's what I'm going to do, because we don't meet till Thursday, is if suddenly the market rallies and this is going to be my stop right here, this low, it's going to be real tight. If the market rallies and chip stocks go below this low, I'm getting out. And the reason why that's going to be important too is, remember, the SMH, remember we were talking about this thing possibly breaking out of here. If it does, I don't want to be short, okay? So I'm going to keep a real tight stop. On the other hand, if the market sells off in the next day or two, the SOXS could go up a decent amount, and we could make some money on it. But what is that low right there? That low is 33.32. So I'm just going to say 33.30. And now here's what I'm going to have to watch though, because I have that really tight stop. It's going to say I could buy like a ton of shares, but I'm not going to want to tie up that much capital. So if I put my stop price here at 33.30, so I could buy like 5,000 shares and still be at a very low portfolio risk. Actually, no, that would be too high. 6. I want it down to 1.5%. So, but the point is that, so if we went down to like 2,000 shares or something, it would tell me that's still too high. But it's because of the tight stop, you have to manage both of those. So I usually want to keep the amount of capital I have, and usually it's been about 180 shares. No, actually I go up 200, 250. 300's too high. Let's go 280. There, 280. So what I'm trying to do here is I'm trying to keep I don't want to have more than 10,000 in each trade. Usually my range is about 7 to 10,000. I'm going to push this one a little bit here. And then I don't want my portfolio at risk above 1.5%. And we are well below that. 0.38%. We'd only lose $462 if we're right. We made that already on the trades we got out of, so it'd be a wash. In fact, we made it on one of the trades, because one of the trades we got out of was about that amount. So let's go ahead and purchase. Now, again, I want to emphasize this is not a real strong bullish candle right here. There's indecision. It's off the highs. We'll see how it closes today, but it's off the highs a little bit. But it could also close. It's right here where it could close above the high of the day before, which would be a pretty bullish close if it could do that. We're right at it right now. I think that's why it's kind of stalled out right there a little bit. But that would be more bullish if it could close above the high of the previous day. And then we just have a tight stop. If it doesn't, market doesn't pull back right here, then we'll just jump back out. All right. Oh, I do want to go over just a couple quick trades just off of the new buy list. We'll see if we have more that look good on Thursday. But again, in these conditions, I don't want to be getting into too much from the long side or the bullish side here. This SLP. Oh no, this one I want to point out. This one's not ready yet. Because this one I want to point out though, because this looks like wave A right here. This looks like the first part of the pullback. Notice how it's trying to rally, but it's sluggish on the rally right here. That looks just like a wave B, and I think this has another move down for wave C. Bearish candle today should lead to a wave C down, maybe down into this area in here, right around 60. And then you know, if it can give you some confirmation, it might be a good entry. This is a pretty good uptrend right here. But that's what I'd be waiting for. So if that's why I wanted to point this one out. It's like this is showing up on a new buy list, but I would, and I guess I could switch it to the signal so you can see. Although it might have shifted. It was a new buy yesterday. It probably moved back down today. Yeah, it moved back down to hold again today. Remember, these things get updated overnight, so this will go back to a hold after today. But it probably has another move down for wave C, and then it could start to move back up. So that's why I wanted to point that one out. Let's go to NOC, Northrop Grumman. Now, I just got out of Raytheon. This one, again, I would wait for it to break out, especially when you got a bearish inside day right here. But if it can break out above here, you have an impulsive move up. This is corrective, right at a breakout area. If it could break out above there, this thing could take off. And where could it take off to? Well, you have a range right here. You take the distance to the top of that range to the bottom of the range and project it upward. It gives you kind of a minimum target. This could be a good one. So in fact, so maybe what we'll do instead of jumping back into Raytheon, if this sector turns around, let's jump into NOC. 90 strength rank, so it's right on that borderline, but that one looks like it could be pretty good. Just wouldn't get into it today because it's probably going to pull back a little bit if that candle holds up. And then last one, this is a little bit lower strength rank, but Hershey HSY 88 strength rank, but and again, very similar chart, very nice steady uptrend, but it's getting ready to break out. I love the stair step, impulsive corrective. We should get an impulsive move up, and I'd wait for the breakout though, because again, maybe it has another move down and then breaks out. But that one looks pretty good. And you've got Halloween coming up. A lot of chocolate can be bought in the next few months, I would assume. Not that I'm going to base it on something like that alone, but it's a nice bullish chart. All right. Question: Are leverage funds literally 3 times the index at the close of the day? They're supposed to be, as far as I know. But what you have to understand about those leverage ETFs is that they reset the next day. They reset the next day. So if you try to buy a, 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 a like a 3-time or 2-time a leveraged ETF, thinking that you're going to make it, I'm going to hold it for 10 years, I'm going to make 3 times what I would make on that thing. No, you won't. In fact, over time, you'd actually probably lose money. So you have to know how they're, and I don't have time to get into explaining them, and I'm not very good at explaining them. They're really complex, but if you go Google dangers of leveraged ETFs, and you'll get plenty of articles that tell you kind of the warning signs. And if you understand the math, then you'll know it. I don't understand the math. I'm not a math person, so that's why it goes over my head, and I don't. All I know is that you don't want to be using them or holding them for long periods of time. They're very short-term instruments. Usually a week or, a few days or a few weeks is not bad, but you don't want to be trying to hold them much longer than that. And that's why even on these inverse ETFs here that I'm using them very short-term just to hedge a lot of times. I'm not going to try to, because they're not going to be, they're complex, so you just don't want to be holding on to too many of those for the long haul. I mean, something like the SPY you can, because it doesn't do that, but the leveraged ETFs are the ones that do that. They will they will lose value because they reset every day. All right, I got to get out of here. Thanks, everyone. If you have any additional questions, just send those to Jerry at traderspro.com. I'll be happy to answer those for you. Have a great week, everyone. See you on Thursday for the stock specific class. Bye now.